Hello everyone, welcome to the Business Safari. I'm Bella, and today we're diving into the world of financial ratios. Financial ratios are tools that help us understand a company's financial health. They're like vital signs for a business, giving us quick insights into its performance. All you need on hand is the company's balance sheet and profit and loss statement. We'll cover 6 basic ratios today, looking at 3 important areas: profitability, leverage, and liquidity. Let's start with profitability. Profitability ratios tell us how good a company is at making profits. Today we'll look at 2 key ratios: gross profit margin and net profit margin. Gross profit margin shows how much profit a company makes after paying for the direct costs of its products. It's calculated by dividing the company revenue into its gross profit, which is revenue minus cost of goods sold. A clothing retailer has a gross profit margin of 40%, meaning for every $100 in sales, they keep $40 after accounting for the cost of goods sold. Net profit margin shows how much profit a company keeps after all expenses. It is calculated by dividing your company revenue into its net profit or net income. A software company with a net profit margin of 15% retains $15 in profit for every $100 in revenue after all expenses are paid. Let's look at leverage ratios. These show how much a company relies on debt. We'll focus on 2 common leverage ratios: debt-to-equity ratio and interest coverage ratio. The debt-to-equity ratio compares a company's total debt to its shareholder equity. It is calculated by dividing total liabilities by shareholders' equity. An automotive manufacturer with a debt-to-equity ratio of 1.5 has $1.50 in debt for every $1 of shareholder equity, indicating significant leverage. The interest coverage ratio shows how easily a company can pay interest on its debt. We calculate it by dividing interest expense into the company's earnings before interest and taxes, or EBIT for short. A telecom company with an interest coverage ratio of 5 means its earnings before interest and taxes are 5 times greater than its interest expenses, suggesting strong ability to meet interest obligations. Lastly, let's look at liquidity ratios. These show a company's ability to pay its short-term debts. We'll cover 2 important liquidity ratios: current ratio and quick ratio. The current ratio compares a company's current assets to its current liabilities. It's calculated by dividing current liabilities into current assets. A grocery chain with a current ratio of 2 has twice as many current assets as current liabilities, indicating good short-term liquidity. The quick ratio, also known as the acid test, is a stricter measure of liquidity. It excludes inventory from current assets. It is calculated by dividing the current liabilities into current assets minus inventory. An electronics retailer with a quick ratio of 0.8 may struggle to meet its short-term obligations without selling inventory, as its liquid assets are less than its current liabilities. These ratios give us a snapshot of a company's financial health, but remember, they're most useful when compared over time or against industry standards. Let's summarize what we've learned about financial ratios. Profitability ratios like gross profit margin and net profit margin show how well a company generates profit. Leverage ratios like debt to equity and interest coverage show how much a company relies on debt. Liquidity ratios like current ratio and quick ratio show a company's ability to pay short-term debts. These ratios are most useful when compared over time or against industry benchmarks. And that wraps up today's Business Safari on Introduction to Financial Ratios. I'm Bella, thanks for watching, and don't forget to like and subscribe for more helpful business videos.